Good day, thank you for joining me. My name is Nasser Carstens, and I'll be taking you through the Investec Property Fund investment idea. Starting off with the executive summary, in terms of segmental exposure, the Investec Property Fund has traditionally been a South African-focused diversified retail, office and industrial REIT. However, property holdings have been diversified in the past few years, and management has proven to be adaptive in the face of the current property market. In terms of the balance sheet, there are some debt concerns. However, management has been partially effective in deleveraging and has reduced the loan-to-value ratio to 38%, which is more or less in line with the broader property market. Valuation indicates that the counter is significantly undervalued and that there is upside potential, therefore we are overweight on the counter. This graph shows earnings recovery as we emerge from the pandemic. In terms of segmental exposure, we can see by these two pie charts that the fund has made two pivots over the last 3 years. Firstly, diversifying offshore and then expanding into industrial logistics properties offshore and in South Africa. This was achieved primarily by acquiring a stake in PEL, which stands for Pan-European Logistics, which consists out of light industrial and logistics properties across mainland Europe, which should provide higher exposure to high-yielding and fast-growing logistics in Europe, and also provide earnings smoothing through diversification. The fund has now completely disposed of all PELI assets in UK and Australia. In broader terms, we have seen retail recover somewhat, with consumer footfall and spending improving, which saw a return to malls and entertainment venues. However, a greater e-commerce presence is likely to structurally deduct from retail consumer spending. Our biggest concern is office, which faces the double headwinds of a weak macroeconomic environment with rising unemployment, with slow growth, and a growing work-from-home trend, which has seen large corporate tenants opting for reduced office footprint. Industrial is well positioned to gain from the structural shifts due to a larger e-commerce presence. However, it seems like it has already been priced in and is quite expensive. Then moving to valuation, the sum of the parts analysis indicates that the counter is trading at a 42.8% discount to the sum of its parts, with the detracting components being primarily the undervalued South African assets. The counter is trading at a 22.6% discount to its target price. In terms of the implied net asset value per share, the PEL portfolio is the greatest contributor to net asset value per share. However, the sizable South African portfolio, which contributes to the majority of property value, is trading at a steep discount. Cap rates have been consistent around their 5-year averages due to a proportionate decrease in net rental income and the book value of property, and are therefore not indicative. And in this graph here, we can see the counter is trading at a discount to its historical average in terms of price to book, and it's also trading at a discount to the South African listed property index. This table indicates in the bear, bull and base case scenarios how the South African assets will be priced once the PEL portfolio has been deducted from the share price. In the most left yellow cell, we can see that once the value of the PEL portfolio has been subtracted from the share price, that the remaining South African assets can be purchased at a price to book ratio of 0.03 times, which is of course very cheap. The base and bear case scenarios only accentuate this with negative values, suggesting an even bigger possible upside in terms of valuation. If you would like to place a trade, please speak to your financial advisor or contact our trading desk. Thank you for listening, and please take a moment to read our disclaimer.